Good morning. This is Mayor Valensky with Driving Markets. Let's look at what is driving markets today. What was driving markets yesterday? So yesterday was a follow-on of the recent downgrade in the banking sector, nervousness about the Fed minutes, which we'll go into in a second, and also overall technology sector looks well overbought and overvalued, and the markets are due a correction, which is what's happening at the moment. They're continuing to fall based on certain fears, starting with the China missing the production numbers and the retail sales on Tuesday, downgrades of the bank, overall sentiment, concerns about the Fed. Let's kick off. So yesterday, the Fed came out with its minutes of its July meeting. Now, if you remember, the Fed paused, then raised rates by 25 basis points, and I stated that there may be another one or two rises throughout 2023, even though it was looking unlikely at the time. However, based on those minutes that came out yesterday, it actually was a lot more hawkish, a lot more aggressive than the market had anticipated. Now, if you add that into all the other factors, that is damaging sentiment and is putting a dampener on the little bull run that we've had since January 2023. Now, the minutes were quite hawkish, and they did state that they maybe have to raise rates again in order to get inflation down. Talking about inflation, inflation itself has bottomed out at the moment. It's gone on a downward trend from January 2023 to where we are now, which is month on month falling, which is great news across the board. It means prices are going up, just they're going up according to the official numbers at a slower pace. I personally don't accept the numbers and believe the numbers, but that's me being cynical, critical, and very suspicious, because the daily cost of living, as we're all experiencing by Joe Public, the man on the street, is simply going up. We don't see any particular discounts or a cheapness in products, whether it's food, energy, clothing, household goods. All we can see is rising prices. But according to the official figures issued by the authorities, whether it's in the UK, whether it's in the US or Canada or Europe, you'll see that inflation is ticking down, but it's probably ticked down just to now the lowest level, and now it's beginning to tick up. And that's what's going to be concerning the Fed going forward. The Federal Reserve is concerned about the trend changing to rising inflation. If inflation goes up and we don't have growth, then we have stagflation, which is rising prices of cost of living, but no growth. Wage inflation is a major concern as far as the Federal Reserve is concerned. They can see there's a lot of pressure on wage inflation, and wages are going up incrementally over month by month, and that is concerning the Fed, because that will stoke up inflation, and that's why the Fed's concerned within its minutes about rising inflation and how to tackle it. So we could see another two rises in the US. If that was to happen, obviously that would impact on bonds and also on foreign exchange, the US dollar. So the US dollar could rise in anticipation of rates rising within the US. So take that into account. Meanwhile, 10-year US Treasury bonds will go to 4.5% yield. At the moment, they're running it around about the 4.2%. That's also a concern. That's one of the reasons why the NASDAQ and the tech sector has fallen, because they are hypersensitive to interest rate rises. They get a lot of funding and are dependent on funding in order to run their operations. So a lot of the tech sector yesterday and the day before and this week is falling. If you take Meta and you take Tesla, for example, Tesla, I said sell at 278 and all the way down to 240, 240, 245. I said the next level is going to be 225. It's hit just below 225. So if it continues going down, we're going to see it at 205 and even at 190. Meta, I was calling down to 290. It is at 290. Could fall down to 275 near term. Depends if there's going to be a technical bounce within the present downward trend, where we're still in a bull market. So you could end up having stocks and shares and indices touching a 200-day moving average and bouncing off from there. So we could have a rise in some of the shares that have come off recently over the last few days. Bitcoin is boring. It's called boring Bitcoin. It's doing absolutely nothing. So all those crypto traders that were looking for a fast moving asset at the moment you can go to bed or take a holiday because nothing's happening regarding the crypto sector. It's very, very quiet. Look, talking about houses and rents, a hell of a lot of pushback on housing and rents. Rents are going up, but houses are going down simply because homeowners and home buyers can't afford the high interest rates they're going to have to lay out in order to support that mortgage. However, rentals are going up as there's a shortage of supplies of properties to rent, and that's across the board globally, whether it's in Canada, US, UK, or Europe. Australia also, rents are going up due to the massive move of immigrants and refugees from one country to another. That's also sapped up huge amount of inventory. So rents are going up throughout 2023, but you will see a fall in rents, in my opinion, of course, in 2024. There's many estate agents, realtors are real anti this channel because they think I'm very, very down on property, but I'm taking a macro view, which is 12 to 18 months ahead. So you can expect more volatility in markets to come off a little bit more before reaching a testing bottom and then probably bounce from there. This is Meir Walensky with Driving Markets. You can share, subscribe, comment, and let's build the channel. Have a great day.